Hello, traders and finance enthusiasts. Welcome to our deep dive into the dynamics of price action trading. Today, we're setting our sights on a particularly compelling aspect of the market, the bullish trend. This trend is not just a sequence of rising prices. It's a story of market confidence and the anticipation of growth. We're going to uncover the layers of a bullish trend, examining a real-life example from the charts that paints a vivid picture of this optimistic market phase. Whether you're just starting out or you're a seasoned trader, understanding the subtleties of a bullish trend is crucial for making informed decisions. Get ready to embark on a journey through the landscape of market highs and lows, where we'll decode the signals and patterns that can lead to successful trading outcomes. It's not about precision strikes, but rather about aligning with the market's rhythm and protecting your downside as you seek to capitalize on the trend's potential. Welcome to the heart of market optimism, the bullish trend. A bullish trend is more than just an uptick in prices. It's a powerful signal of trader confidence, a period where buyers consistently outweigh sellers, driving prices upward. It's the wind in the sails of investors, indicating economic growth, positive news, and a robust market sentiment. But how can we spot such a trend? Look for a pattern of higher highs and higher lows. Each peak surpasses the previous one, and each dip stops short of the last low, creating a staircase leading upwards. This pattern is a trader's beacon, guiding us towards potential opportunities for profit. In a bullish trend, each rise and retreat tells a story of market forces at play. It's where the strategic entry points lie, where the narrative of supply and demand unfolds. Understanding this trend is essential because it allows us to align with the market's momentum, to ride the wave rather than swim against it. In the language of the market, a bullish trend is a strong dialect. It speaks of resilience, growth, and progression. By recognizing and respecting this trend, traders can position themselves to take advantage of the market's generous offerings. As we gaze into the graph before us, the bullish trend unveils its characteristics through the dance of its candlesticks. Visualize this. Each candlestick is a soldier in the army of buyers, marching forward to the rhythm of market optimism. The chart is our battlefield, and the patterns formed are our strategies for success. Notice how, within this trend, each green candle burns brighter and stands taller than the one before, crafting a series of higher highs. This is the market's way of shouting confidence. Meanwhile, the red candles, shorter and subdued, gently dip to form higher lows, revealing the buyer's unwavering resolve not to retreat too far. These patterns are like footprints on the path to profitability. By learning to read these signs and signals, you can harness the trend's strength, aligning your trades with the forces that propel the market upward. In every journey, there comes a moment of calm, a time to gather strength for the next leap forward. In the narrative of our bullish trend, this moment is the consolidation phase. Picture it on our chart. A series of candlesticks, neither gaining nor losing significant ground, moving sideways as if in a strategic huddle. This phase plays a pivotal role in the bullish saga. It's a time of accumulation, where savvy traders are quietly building their positions, preparing for the anticipated ascent. The consolidation whispers of potential energy like a coiled spring, ready to release. It's a battleground where the forces of supply and demand reach a temporary truce. But what of the psychology behind this phase? Consolidation often tests the patience of traders. It's a reflection of the market's hesitation, a collective breath being held. Yet, for the astute observer, it's a signal that something significant is brewing. The longer the consolidation, the more powerful the potential breakout. As the market ebbs and flows in this phase, it's not just prices that are being consolidated, it's conviction. The breakout from this zone will reveal where that conviction lies. Will the bulls charge ahead, or will the bears push back? Understanding this stage is crucial, as it can foretell the next chapter in our bullish story. Spotting the hammer transitioning now from the broader view of our bullish trend, we arrive at a pivotal moment of decision, the entry point. Among the most reliable harbingers of opportunity is a pattern known as the hammer. Picture this. A candlestick with a small body at the top and a long wick below. It resembles a hammer, ready to strike. The hammer emerges after a pause in the bullish ascent, a period of consolidation where the market catches its breath and traders ponder their next move. This pattern is significant. It represents the market shaking off any doubts, with buyers pushing back prices to close near the opening level, despite any sell-off that occurred. When this hammer appears, especially after consolidation, it's a potent signal. It tells us that while sellers may have attempted to drive the market down, the buyers have regained control by the close. It's a sign of resilience, a whisper of persistence from the bulls, suggesting that the trend is likely to resume its climb. The presence of the hammer after a consolidation phase is a green light for many traders. It's an invitation to consider joining the bullish brigade as it prepares to march onward. This pattern is a beacon, one that can guide you to enter the market with the wind of buyer confidence at your back. As the market's heartbeat resumes from the quietude of consolidation, our attention sharpens on a critical event: the breakout. It's a defining moment where the hammer candlestick makes its indelible mark, igniting the next leg of the bullish trend. On our chart, this is where we see a decisive close above the resistance formed during consolidation, a clear battle won by the bulls. This breakout is not just a mere shift in price, it's a reaffirmation of the bullish commitment. It signals that the buyers, once again, are taking the reins, pushing the market to new heights. The appearance of the hammer candlestick here is a clarion call, a powerful indication that the uptrend is not only intact but rejuvenated. But how do we validate this movement? Volume is your ally here. A breakout with substantial volume lends credence to its legitimacy, signifying a collective move by the market participants. Alongside other indicators such as moving averages and momentum oscillators should align, pointing upwards, confirming the bullish vigor. The breakout from consolidation, backed by the hammer and reinforced by robust volume, is a symphony to a trader's ears. It's the moment of action, a time to consider positions and ride the wave of the trend's resumption. In the art of trading, entering a position is about striking a balance between timing and prudence. After spotting the hammer signal, our strategy pivots towards crafting a well-placed entry. It's about finding that sweet spot where the potential for reward aligns with a controlled level of risk. Consider the area around the hammer candlestick as your staging ground. It's a zone that has shown recent activity and interest from the market. This region, influenced by the consolidation that preceded it, tells us that the price found a level of harmony there, making it a meaningful location for planning your entry. As you pinpoint where to enter, it's vital to think about safeguarding your capital. A prudent trader always has an eye on the exit door, should the market turn. Setting a stop loss is not just a safety measure, it's a declaration of your trading discipline. Place it at a point that respects the market's previous behavior while allowing enough room for the usual ebb and flow of prices. Engaging the market without overcommitting, using the recent consolidation as a compass, puts you in a position of strength. It's not about precision strikes, but rather about aligning with the market's rhythm and protecting your downside as you seek to capitalize on the trend's potential.
3, 2, 1.
As we reach the conclusion of our journey through the bullish trend, let's take a moment to reflect on the key insights we've uncovered. We've navigated the terrain of the bullish trend, understanding its significance and identifying its characteristics. We've seen how patterns like the hammer candlestick serve as beacons, guiding us to potentially lucrative entry points. Remember, the essence of trading within a bullish trend lies in recognizing patterns, understanding market sentiment, and aligning your strategies with the trend's direction. The hammer candlestick, emerging from consolidation, has shown us how patience can reveal moments ripe for action. Now, as you step back into the world of trading, armed with these new insights, remember that success in the markets is not just about knowledge, it's about application. It's about patience in waiting for the right signal and discipline in managing your risks. The market is a dynamic entity, always in flux, and your ability to adapt and apply these principles will be your compass. Implement these strategies in your trading with care and consideration. Let the lessons of the bullish trend and the hammer candlestick guide you, but anchor them in the broader context of your trading plan and goals. Thank you for joining me on this exploration. As you continue your trading journey, keep learning, keep refining your approach, and above all, trade with confidence and discipline. Until next time, happy trading.